There's dozens of different accounts you can invest in. And when it comes to retirement accounts, they can be relatively confusing. But what if I told you there's one account that you can invest in, that you can get a triple tax benefit? You can save money in taxes today, you can invest for tax-free growth, and when you take it out for the right reasons, you can take it out tax-free. Hey everyone, my name is Jacob Turner. If we haven't met before, I'm a financial advisor for professional athletes and entrepreneurs. And in today's video, I'm going to teach you about my favorite account that's out there. So let's dive in. I want us to think about this video in 3 segments. We're going to talk about what the account is. Secondarily, we're going to talk about how you can use it and who actually qualifies to use it. And thirdly, we're going to talk about how you can maximize it and how I maximize it for myself. So what account am I talking about? I am talking about an HSA, or better known as a health savings account. Now you might be thinking, health savings account, is that like an account just for medical things, or is that like a retirement account? And what I'm going to tell you is, it's a little bit of both. And here's how you can use it. A health savings account works like this. It means that if you are on a high deductible healthcare plan, you qualify. So high deductible, what does that actually mean? Well, the IRS explains it like this. In 2025, if your deductible per individual on your plan is over $1,650, you qualify. Or if your deductible as a family is over $3,300, you qualify. So ideally what the IRS is saying is, hey, if you have a deductible, you have a healthcare plan that you're going to come out of pocket for a lot of money in the future, we want to give you some sort of account that will help soften the blow of that. And that's what an HSA is. So if you're on a plan like that, you're on what's called a high deductible plan, you qualify for a health savings account. And here's why I always recommend you contribute to this account. It is an account that provides a triple tax benefit. And what that means is the money that you put in, you get a tax deduction when you put that money in. That money grows tax-free, and if we use it for qualified medical expenses in the future, that money also comes out tax-free. A triple tax benefit. Now, you might be thinking, okay, this sounds great, but is this really complicated for me to open? Because when I think about tax benefits, the thing I'm always thinking about is, what is the benefit I'm getting? And then how complicated is this going to be to do it? Because the reality is we could all move to Puerto Rico and save money in taxes. But if you're anything like me, I don't really want to move to Puerto Rico. I don't want to go through all that. But I do want to do things that are really simple, that aren't going to take me a ton of time, that are going to save me money in taxes. And the HSA is at the top of my list. So here's how it works. You can go to any major brokerage account and you can open an HSA account. I personally use Fidelity for mine. And you can open it just like you would open an IRA or a Roth IRA or a taxable brokerage account. And like I said, mine's at Fidelity. It's very simple to open. It takes a few minutes and it can provide huge benefits. Now, the second thing I want to talk about is what is the best way to actually use this account? Now, we've already talked about all the benefits, the triple tax benefit of doing this. It sounds too good to be true. And the IRS says it is a really big benefit. So we're not going to let you just contribute an unlimited amount of money to this. In 2025, a family can contribute $8,550 to this account, or if you're on an individual plan, you can contribute $4,300. If you're over the age of 55, you can also make a catch-up contribution of an additional $1,000. So this isn't a massive amount of money. This isn't hundreds of thousands of dollars you can contribute every single year, but it's still a relatively significant amount of money. And remember, the money that you're putting in, you're getting a tax deduction on the upfront. So if you're making $100,000, and if you contribute the maximum of $8,550, your tax bill, what the IRS actually taxes you on, will reduce to $91,450. A pretty good deal. In addition to that, what I see too often is people contribute to this account, but they don't actually maximize it the correct way. So I want to show you how you can maximize it the right way and actually take this $8,550 benefit and turn it into potentially hundreds of thousands of dollars in benefit down the road. So let's use an example. Let's say we have an HSA, we're on a high deductible plan, we qualify to contribute to it, we contribute to it. And the next thing we know, 6 months later, our son, our daughter, ourselves, our wife, our spouse, they have some sort of injury that they have a qualified medical expense. It's going to cost $1,000. And we decide, do we want to take $1,000 out of our HSA account to pay for this, or do we want to pay for it out of cash flow? Now look, the HSA account is there to be used for qualified medical expenses. So it's not an inherently bad thing if we take the money out of the HSA account to use for that qualified medical expense. Remember, you still got the tax deduction on the upfront. But what if I told you that you can actually supercharge this account by not using it at the beginning for qualified medical expenses? Instead, what I would recommend is if you have the ability to pay for those qualified medical expenses out of cash flow, you can actually invest your money that's inside your HSA. As I mentioned, my account specifically is at Fidelity. I have my account in a very similar model to what I have all my taxable investments in. It's almost entirely in equities or stocks. And what that means is I have a very high expected rate of return, somewhere between 8 to 10%. It's also going to fluctuate over time, but I'm using this account essentially as a long-term planning vehicle for myself in retirement. And I want to explain the difference. Remember, we talked about this scenario. I have a $1,000 expense for my family. It's a qualified medical expense. Do I use my HSA? You certainly can. And I would recommend, if you do not have the cash flow to be able to pay for that qualified medical expense, yes, use the HSA. That's what it's there for. But if you can cash flow that medical expense and you can keep that money in your HSA and you can keep that money invested, I want to share some math with you. On an $8,550 contribution, if we did that for the next 10 years, which is something that I've been doing for the last 4, I plan to do for the foreseeable future. If we do that for 10 years, so we make our $8,550 contribution, we do that for 10 years, we return 8% a year, a very reasonable rate of return. We would have more than $133,000 in our health savings account in a decade. Now, you might be saying, well, Jacob, what am I going to do with all that money? Because remember, in order to take it out and get the tax benefit when you take it out, where there's no tax consequences, you do still need to make sure you're taking it out for qualified medical expenses. But I want to give you 2 other scenarios. Remember that $1,000 expense that we had? Remember I said that we could pay for it out of cash flow? Let's say we did. And let's say we went with scenario 2. We invested this money in our HSA. We let it grow for the future. Well, in the future, you can actually go back, and if you kept the receipts, which can be a really simple process, you can have one account where you scan receipts into for any big medical expense that comes up. You could actually pull that money out at any point in the future for that medical expense that happened years and years ago. In addition to that, the second big thing that you can do is you can essentially use it as a long-term care policy. We are healthier than ever. We are living longer than ever. And what that means is when we live longer, there's going to be more expenses down the road for healthcare and medical expenses. I do not have any sort of long-term care insurance for myself. Now, that's specifically related to my situation. You need to look at your own situation. But what I am using my health savings account for is a self-funded long-term care policy. And I'm thinking about it like this. I put in my $8,550 a year. That money is going to grow with the investment I have. Is also the contribution limit is going to continue to go up with inflation. I am anticipating that by the time that I actually want to use this money in retirement, that I will have a few $100,000, if not a few $1 million in this account. And it's going to be an incredible benefit because if I ever go into any sort of assisted living community, if I have anybody come in to help take care of me and my wife, we're going to be able to use that HSA money. So that HSA, remember we talked about at the beginning, my goal with taxes is I want things that are simple to use, that give me a big tax benefit down the road. And on the surface, the HSA, you're like, it's only for health savings, it's only for qualified medical expenses, it's only $8,550. But remember the math we just talked about. If we can contribute to that account, if we can invest that account, if we can cash flow current medical expenses out of what we're making from our jobs today, and we can let that money grow, that $8,550, that can become hundreds of thousands of dollars, if not millions of dollars in benefit in the future. And remember, all along the way, we're getting a triple tax benefit. We got a tax deduction when the money went in. We got tax-free growth on the money. And when we took the money out for those qualified medical expenses, whether they happen this year or 10 years down the road, we're getting a tax-free distribution. So remember, like I always talk about with retirement accounts or health savings accounts or any sort of account where we're getting some sort of tax benefit, we need to be thinking about not just our contribution strategy, but also our distribution strategy. If you have more questions about taxes, make sure you go back and watch some of my earlier videos on this tax series to give you a foundational knowledge of what you should be thinking about to lower your lifetime tax bill. And as always, my goal is to help you get smarter with your money. Until next time, my friends.